Now you know what options are and you know how they work, but options are not only buying or selling a call or put option. You can build complex strategies depending on what you want. For example, you can make a strategy that the stock can go in any direction and you can still profit. So before going into any strategies, we need to understand how those PNL charts work. Like any graph, we have the x-axis and the y-axis. On the x-axis, we have the stock price, and on the y-axis, we have the PNL. So from very basic knowledge, you should understand that whatever line we draw, the crossover between the PNL line and the zero, it's your break-even points. Because at this point, your profit is $0. So whatever line you see, for example, for a call option, this line will show you your profit and loss chart on the expiration date. If you use a broker like Interactive Brokers, for example, this is your PNL chart on the expiration date, which is December 3. You can actually change, for example, I want today, November 15. What is my PNL chart? So I can actually see my PNL chart on November 15. And you can change to any date between the day you're trading and the expiration date. A very basic call option will have a diagram like this. We know that when we buy a call option, your maximum loss is limited, which is the premium you paid for. And when the call option is out of the money and it expires, your loss will be the premium you paid for. You can see for all the stock price below here, you can see your loss is limited. But after this point, which is your strike price, when it goes in the money, you can see your profit going up. And theoretically, there is no limit because the stock price can go up infinitely. But of course, practically that's not possible unless it's GameStop. You can see your break-even point. It's not when it's going in the money, which is after the strike price. It's the strike price plus the premium you paid for. So your break-even point, for example, if your strike is $100 and the premium is $10, your break-even point will be $111. And now everything is inverse when you short a call option. Your profit will be limited and your loss is theoretically infinite. So you're always going to get paid the premium, but if the stock goes in the money, which is here, you need to sell 100 shares for the option buyer. So your maximum profit potential is when the stock is zero. So when the stock price is here, zero, your maximum profit potential is here. And you're going to draw a line until your break-even point, and after your break-even point, your loss is limited. You can't lose infinitely. Your loss is limited. That's why we draw a line like here. For example, the amount of premium you paid is $50. So your maximum loss is always $50. Maximum profit potential is when the stock is zero. For example, you can make 1K from that trade. And of course, it's the inverse when you sell a put option. Your maximum loss is when the stock is zero, and your maximum profit potential is the amount of premium you collected. Here it's the strike price, and here it's your break-even point. After that, I explained two more concepts. I'm going to explain how you can adjust your risk-reward ratios and your win probabilities, because each option contract provides a different win rate and different risk-reward ratios. So the first concept is the spreads. Spreads are the action of buying and selling a call or put option at the same time and at the same expiration, but on different strike prices. And it gives a totally different outcome. For example, the bull put is the action of buying a put option and selling another put at a lower strike. For example, this is an example of bull put. Your loss is limited and your profit potential is limited. And you can make money when the stock price is going up because it's a bullish strategy. This is another example of a bear call. For a bear call, your maximum profit is limited and your maximum loss is limited. It's the same idea as a bull put. But the difference is that you can make money when the stock price is going down. The last kinds of charts you're going to see is the iron condor. If you combine both a bearish spread and a bullish spread, you'll get an iron condor. Basically, on an iron condor, you're not betting on any side. You just want for the stock to make a significant move upward or downward, or it stays within a range. This is an example of iron condor. Your maximum return is $538, and that's going to happen when it stays between, for example, 205 and 210. And your maximum loss is 462, and that's when it goes below $195 and goes above $220. So in this kind of chart, you're betting that the stock will not do a significant move upward or downward. This is another example of iron condor, but it's different. This time you're betting that the price will do a significant upward or downward move. This is good when you're expecting the stock will do a significant move upward or downward. For example, there's news pending, but you don't know if that's good or not. So you can just bet both sides. If the stock does not move at the expiration date, your maximum loss will be $926 and your maximum profit potential is around $600, and that's when it goes above $215 and goes below $178. So now we're done with the scenarios that you can face with. We're going to explain more advanced stuff. On this trade, for example, it's a bear call. You can see your risk reward ratios is 1. Why? Because your maximum return is $500 and your maximum loss is $500. So that's 1-to-1 risk reward ratio. And your profit probability is 42%. Now let's say you're a guy that likes to have a really high win rate. You don't want to lose. You can actually increase your profit probability. Let's take another scenario. We know that when you sell a call option, the more you go out of the money, the higher chance you have to win, because there's more chance that this option will expire worthless. And when you're selling those options, you have a better probability to win. So let's take another scenario of a bear call and we go more out of the money. I'm going to sell this call and I'm going to buy a higher strike call option to reduce my cost basis and to do a bear call, so I'll have a limited loss and a limited profit potential. So let's check the PNL chart of the strategy. You can see my win rate increased to 86%. That means I have 86% chance to win on this trade. My maximum return reduced. And there's something else. My maximum loss increased to $2,300. So from this you can understand that almost everything is priced in options. You want to increase your win rate, your risk reward ratio will reduce. If you want to have a better risk reward ratio, your win rate will reduce. So that's why everything is priced in options. But there's a catch here. To reach your maximum loss, there's less than 1% chance for that to happen. So if you are super unlucky, you're going to have this loss. And for this case is that before December 3, PayPal needs to reach $250. This is the chart of PayPal, for example. Before December 3, it needs to reach $250. So in less than a month, it needs to make a 20% move, which is very unlikely for a large cap. And the option delta will tell you the probability that you can win. Your maximum return, it's $131, and your profit potential is 85%. So if you actually combine with technical analysis, you're almost going to have a 95% win rate. Let's take another example. I want to say in long term, for example in February 18, after 100 days, I'm confident that PayPal is going up. So I can actually do in the money bull put. I'm going to sell a 280 put and I'm going to buy back a 240 put. If we check the profile of this PNL, my maximum return is $3,500 and my maximum loss is just $400. Your win rate is going to be 20%. This is a good strategy when you're confident where the stock price will end, but there's some risk to it. For example, let's take an example on Alibaba. We know that at this stage it's super undervalued. Let's check the chart of Alibaba. It's currently $168 and we're confident that long term, if there's no news, it can go up to $220. I'm going to sell a 225 put and I'm going to buy back 195 put. As you can see here, this is a bull put. If we check the profile of this chart, my maximum return is around $3,000 and my maximum loss is just $260. But your win rate, it's just 10%. So you can use options depending on what you have. For example, on this scenario, as we said, when there's risk, if there's another crackdown on the Chinese stocks, they can really drop. But to be protected, you're going to have a very limited loss. But if it goes in your direction, you can profit a lot. So as said, you can use options depending on what you have or what kind of bets you're going to put. If you think the stock will not be volatile, you can buy an iron condor. If you want to set a maximum loss, you can do a bull put. And now you know that you can change your win rate and your risk reward ratios depending on what kind of trades you're betting on.